welcome back to the Wealth Creators Club this week. And in this episode, I'm going to be showing you I'm actually going to be invested in terms of stocks and index funds to achieve my £1 million retirement plan. First part of the video, I'm going to be showing you why I'm doing this, what's the point in investing, why am I actually doing this for the future. Then at the second part of the video, I'm going to be showing you what I'm investing in and how I'm actually doing it. I want you to understand investing. I don't want you to just copy me because this is not financial advice. I'm not a financial advisor. This week, you might have noticed that my background is slightly different. I'm out here in Dubai. If anyone's got any recommendations of things I should do, then do let me know in the comments below. Investing's too risky. You shouldn't be doing that. Just put your money in the bank and forget about it. Investing is risky, and they are right in saying that. And there's something that you always need to know is that your money is always at risk, and you must be careful when you're investing. And also think about this. Let's say that you had £20,000 in the bank 20 years ago. So around 2000, house prices were average of £90,000 in the UK. So that would have got you a really good deposit, and you would have had some money left over to be able to do the house up and maybe have a new kitchen, maybe do a new bathroom. Let's say that you kept the money in the bank until now. The average house price now is around £280,000. So you wouldn't be able to afford a deposit with that money. It would have become worth less. And that's what I'm saying, element of risk of keeping your money in the bank because of something called inflation. That's inflation. This is when the price of everyday goods go up in value and your money can no longer buy the same amount of things. You probably notice it, especially in the last few years if you've been taking note. Electricity's been going up in price. Housing's been going up in price. Food's been going up in price. Petrol's been going up in price, and all that money in the bank can no longer buy the same amount of things. For me, yes, investing is risky, but there's also an element of risk of just keeping your money in the bank. One of the reasons why I invest and I choose to invest is because I want my money to outpace inflation, and I want it to be worth more than it is now so I can still buy the same amount of things in the future. Look, we're getting robbed. We've got to work extremely hard anyway to earn our money. Then when we put it in the bank, it becomes worth less. We've also got to take the risk with investing. So we earn the money, take the risk to try and invest it. So it's not an easy place to be. But this is our current financial system. Yes, we're getting robbed, but this is just how it is. We can't complain. We just have to act now. Oh, relax, Andy. Jesus, heavy video. Whoa. Came on a bit strong there, but you need to know the truth that investing is risky, and they'll tell you it's risky because that is true. But what they don't tell you is that keeping your money in the bank is also risky. Both of these things require risk management. So what do I mean by that? So with investing, one of the main things that you can do is diversify into well-known assets. So diversification allows you to spread your money across multiple assets, different companies, countries, technologies, spread your money around, and this overall will reduce the risk. Similar to having all of your money in one bank. If something happens to that bank, then your money could just disappear. So it's the same with investing. If you've got it all tied up in one asset class or in one single asset, then there's more chance of something's going to go wrong. So if it's spread out across multiple assets, which have proven to do well in the past, which look like they're going to do well in the future, then it reduces the overall risk, and that's why I'm happy to invest. This diversification that I talk about actually moves me greatly on into index funds. So index funds can be seen like a basket of stocks which can track the overall market or a specific market. Index funds that I'm going to show you now allow me to spread my money across different countries, different companies, different business sectors, and even gold and silver, which allow me to spread my money as far as possible, but not too far that will reduce my gains, but far enough just to reduce my risk. I want to give a shout out to moneyandshackle.com, which is a great YouTube channel I recommend you go and subscribe to. I'll put a link down the bottom, but this is where I got that index fund portfolio from, so it's not financial advice. The first one I pick is the Vanguard FTSE Developed World, so VHVG. There's 23 developed markets and some of the largest public companies in the world. See here, these are the top 10 countries that my money gets exposure to. United States is the heavily exposed one, which is 64%. I'm good with this because this is one of the largest economies in the world. I see it doing better than it is now in the future, and it has some of the largest companies which I don't think are going to go anywhere. And then if anything was to happen to some of these other countries or even the United States, then I'm also weighted in some of these other countries. Gives my diversification and kind of allows my portfolio to continue to grow and not have exposure to one specific country. Of countries, companies, which again increases the safety. So the biggest holdings are in the US, but it has some of the large companies like Amazon, Microsoft, Apple, all of these companies which I think are really good companies and still have room to grow in the future. They're all doing a lot in the background, but instead of picking one company itself, I can have exposure to all of these different companies and countries. That just increases the safety. You can see here, these are all the different business sectors that it covers. So you've got things such as technology, finance, energy, consumer products. So not only is my money in different countries, it's in different business sectors, it's in different companies, which again reduces my overall risk. When I look at is the iShares MSCI World Small Cap, and that code is WSML. This has exposure to the same countries as above. It contains smaller companies, so the market capitalization is between 300 million and 2 billion in market capitalization. Now that sounds like a hell of a lot of money because it is, but it's much smaller than the companies in the developed world ETF. These often provide more growth than larger companies and usually grow at a faster rate. So because of that kind of will increase my returns because these smaller companies have more room to grow. It covers 12 different business sectors, 10 different countries, and over 3,000 different companies, which again is further increasing my diversification. Different business sectors, so as you've got here, industrials, finance, healthcare, information technology, utilities, communication, again further increasing my diversification. So the third index fund that I pay into every single month is the iShares Core MSCI Emerging Markets, and that code is EMIM. Gives me exposure to 2,800 medium and small cap emerging market companies, 13 different countries, so that's again good for diversification. These emerging markets are things such as China, India, Taiwan, Korea, Brazil, Saudi Arabia, South Africa. So the expectation is for these countries to outperform and grow faster than the developed countries that I've previously discussed, likely increase the returns in my portfolio. Diversification of companies, business sectors and countries provides that increase in safety. Companies here such as Samsung and Alibaba, which again are big companies, but they're still part of the emerging markets, so they've got very strong companies in the emerging markets. Emerging market is an economy which is transitioning into a developed economy such as China and India. I keep saying diversification is key to reducing risk. Money is being covered off in different countries, different business sectors, and reduces my risk. The final two is that I put my money into index funds, precious metals, so gold and silver. Called gold, and that's SGLN. So it gives exposure to the gold spot price, so that's the current price of gold. Instead of buying a bar of gold, I buy this fund, so I kind of own some gold in my portfolio. And the reason for this is that precious metals such as gold are real money, and I've had a history of protecting a portfolio during a market downturn. Investors often put their money into gold to kind of hedge that and kind of keep their portfolio afloat. So that's one of the reasons that I'm picking gold. Also see in the future that gold is going to be something that's going to be considered valuable, so I'll keep exposure to that using this fund. And the second one is the iShares Physical Silver, and this is exactly the same as gold. Got the exposure to the silver spot price, protecting my portfolio during a market decline, so when the economy isn't doing so good like we're seeing at the moment, these precious metals should hopefully hold up the portfolio. Final two things that I'm putting my money into in terms of stocks is Apple and Tesla. Investing in specific companies is a lot more difficult because you have to do the research into the company. You're looking into balance sheets, like what the products they're doing, what it's looking like they're going to be doing in the future. You don't want to be just looking at the stock, and it's quite rare that is something that you really care about when you're investing in a company. It's something that you're going to take into consideration when you're investing, but when you're starting off, you just want to be researching into the company. Is it a good company? Is it worthwhile putting your money into for the long term? And that's why I pick Apple and Tesla. Apple especially because I think it's a great company. It pays a dividend. It's got a lot of projects that they're looking to do in the future. They're looking to go into virtual reality headsets, maybe even electric cars. And they're a technology company, so they could actually go into any business sector they kind of want to. I use Apple products every single day. I use my iPhone, I use my Mac, and I see millions of people doing the same thing. Apple just disappearing one day and just going, very unlikely, I think, because they're one of the largest companies in the world. It's not impossible, but as the largest company in the world, I feel safe putting my money into Apple because it's not just going to disappear overnight. The stock price may come down, but I see this as a good company, so I continue to buy it. Tesla is also another great company. We like them. The blueprint for electric cars, they've given that blueprint to kind of the rest of the car industry, but they're really far ahead with driverless vehicles. They've got the cameras on the road already inserted into the car, so they're picking up the driverless technology faster than any other car out there. So they're looking to go into driverless taxis. They're also getting into the electric lorry industry. There's many things that they're doing that I think that in the future they'll be continued to be considered one of the biggest companies in the world. And this is the research that I've done into these two companies and why I feel comfortable putting my money into these. This is higher risk, but the reason I do that is the index funds are kind of the core of my portfolio, the safety net, and then the individual stocks then will help to increase the overall return. Finished yet, because there's one thing I still need to cover, and that's my strategy, which is long-term investing. Another way to reduce risk, I know I keep banging on about it, risk. And I pick long-term investing, so staying invested for a 20-year or more period, is because nobody has actually ever lost any money in the markets for investing for over 20 years. Long-term, the stock market, as you can see, It slowly goes up, it goes down, but then it slowly creeps back up. Obviously this might not continue, but I think it's unlikely that it's going to go to complete zero. I think it's important to see that this is why I picked that strategy of long-term investing. So short-term investing, or might be considered more trading, we're only doing it for like maybe 6 months, is much more risky, because as you can see, the stock market goes up and then it can have a huge drop down to consider with short-term investing, and that's where the risk comes from. But what I'm all about, like I said, is reducing my risk. So by holding for the long term, that has proven in the past that it's a great strategy over a 20-year period, and I don't think the stock market is just going to disappear and go to zero. And if it did, we'd be in a lot worse situation and money wouldn't really matter. Maybe some of these companies will go bust, but they're in the index fund. So the index fund manager will remove that company and put a new company in. What I did is I set up a stocks and shares ISA with trading 2 and 2. A stocks and shares ISA is an account in the UK that allows you to invest up to £20,000 per year in every tax year, and you can invest that money absolutely tax-free. So in the future, when your portfolio gains and returns the amount that you think it should, that will be completely tax-free. Use free trade as well. I haven't used their ISA. I know it costs $5.99 a month, but I have used free trade to buy some stocks. So I find it's better because there is no monthly cost. There's $5.99 with free trade, but it's still a very good app. And if you want free shares to eat any of these, sign up, then there's a link below to get those free shares. You can't open up 2 ISAs in the same tax year, so don't open up a stocks and shares ISA with trading 2 and 2 and free trade and pay into them both. You can't do that. Up this pie in trading 2 and 2, and that's basically just kind of my portfolio, and it allows me just to add stocks so I can automatically invest. So you can see here that I've just added I've got the index funds that we've talked about, I've got gold and silver, and I've also got Apple. I don't have Tesla in this pie. I only buy Tesla every now and again. I don't buy it all the time. So I have a couple of shares. It's mainly this portfolio here that I pay into. Transferring money from my bank account into the ISA, trading 2 and 2 ISA. I use the bank transfer, so standard bank transfer. You can also do card payment, but there is a cost with a card payment. Bank transfer just to save me a bit of cash. I'll do that every single month when I get paid. Goes into the ISA and then it goes into the pie. Then I can just click to invest, and then it'll automatically invest into those index funds and Apple and the gold and silver, and that's all I have to do. It shows you this expectation of what the account value will be in the future. Previous returns, so it's saying that this portfolio has had a previous return over the last 10 years of 15%. So there's no guarantees that that is going to continue in the future, but if I can aim for at least a 8% return, even if I can get a 6% return, not fantastic to keep up with inflation, but 6 to 8 the stock market has averaged over the last 50 years, even 8 to 10%, then I'll be happy with the value that I get. So this is what is showing that the value will be in the future, and the reason for that is compound interest. Compound interest is one of the 8th wonders of the world. Basically what it is interest on top of interest, and this is kind of how it works here. You can see the deposits go in, and then you get the interest, and then the interest on top of the interest, and the interest on top of the interest, and then it creates this kind of snowball effect then, and that's how you ultimately get to those final values that you can see here. My plan, that's my how and why of my retirement plan and what I'm looking to do in the future. If you do agree with it, let me know in the comments below. If you don't, then also let me know, because I want to see how I could improve it. And if you do like the content, like and subscribe, because it's really going to help out this page and help it push it to more people who are looking to do the same thing. But it's not financial advice, always remember. And in the meantime, more investments. These aren't the only things that I invest in. This is just the stocks and index funds that I wanted to talk about in this video. But in the next few videos, I'll be talking about the other things that I invest in. Again, the how and the why, because I think that's important. But in the meantime, I'm going to be trying to increase my income through my business and through my cybersecurity job, so I can use that money to invest more into assets and to also to myself. So if you do enjoy this content, like I said, like and subscribe, and I'll see you next week, where I try and post these every Wednesday. And if there is anything you'd like to see, do let me know in the comments below if there's any content that you want me to cover. If you want to get in touch, like I said, I'm out in Dubai. If there's anything you think I should do, or if you wanted to meet up, then do follow me on Instagram, follow me on my TikTok page as well, and it'd be great to meet up. But thank you for watching, and I'll see you again next week.